The US dollar is about to lose its reserve currency status to this international currency. Here is why you should be concerned. What you shouldn't be worried about is the Nasdaq. Michael Burry just capitulated on March 30th. That he is wrong to say sell, which happened on January 31st. He said going back to the 1920s. There has been no buy the effing dip generation like you. So congratulations! Does this mean we should turn bullish and ride the Nasdaq new bull market to the moon? To be honest, I do have a 17% gain on my most recent stock that I bought last week. My good boys can see my every move from my Patreon. From this banking crisis. China and France has completed the first liquid natural gas trade using yuan. Saudi Arabia not only considers accepting yuan for oil sale, but also partnered with China to build refinery for 83 billion yuan. Our adversaries are teaming up. They want to crash our economy using inflation, while China has the lowest 1% inflation. Is the US dollar's dominance weakening? Are we about to lose the reserve status? I will explain it all right after this. Here is my client's collaboration book, Adversity Equals Success. Such an amazing book. And my book, Treasures Within Our Heart. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. Push my button, the like button, if you like what you see in today's video, because I can't push it from this side. The like button. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? Since the 1970s, it's been virtually impossible for a country to function without access to US dollars. And Washington maintained this highly favorable status quo by putting various kinds of pressure, from sanctions to election theft to outright invasion, on anyone who stepped out of line. This weaponization of the world's reserve currency has not surprisingly created resentment in a lot of foreign capitals. And after a long gestation period, that resentment is now erupting into a rebellion against dollar hegemony. Among the big recent events, the BRICS coalition has become the hottest ticket in geopolitics. Brazil, Russia, India, China, and South Africa, the BRICS, have been toying with the idea of forming an economic monetary counterweight to U.S. commerce since 2001. But beyond some aggressive gold buying by Russia and China, there has been more talk than action. China and Brazil agreed to use yuan in cross-border transactions. Russia considers using Chinese yuan as reserve currency. Then the floodgates opened. Whether due to the lockdown supply chain disruptions or just the fact that de-dollarization was an idea whose time had finally come. The BRICS alliance has suddenly become the hottest ticket in town. In just the past year, Argentina, Indonesia, Saudi Arabia, Iran, Mexico, Turkey, the United Arab Emirates, and Egypt have either applied to join or expressed an interest in doing so. And new bilateral trade deals that bypass the dollar are being discussed all over the place. Combine the landmass, population, and natural resources of the BRICS countries with those of the potential new members, and the result is more or less half the world. And now things are getting real. China brokers a peace deal between Saudi Arabia and Iran. Two bitter historical enemies who want to join the BRICS alliance, but can't if they're in an undeclared war. Should they stop competing and start cooperating? They could dominate the Middle East and raise China's clout in the region at the petrodollar's expense. Russia and India agreed to trade oil for rupees. Russia is now India's largest oil supplier. With 35% of that massive, growing country's imports, the US is not happy about this. But India doesn't seem to care. Brazil and Argentina announce a common currency. In February, the two dominate Latin American economies announce plans for a common currency called the SUR for use in bilateral trade. South America is a big, resource-rich place with numerous grudges against its intrusive northern neighbor. So a de-dollarization movement there, while not as immediately consequential as what's happening in the Middle East or Asia, is both plausible and potentially serious for the dollar. The greatest danger to dollar hedge money and the strategic power that it imparts to Washington is not China's ambition to expand the international role of the yuan. The danger comes from the exhaustion from the financial mechanism that made it possible for the US to run up a negative $18 trillion net foreign asset position during the past 30 years. America's chronic current account deficits of the past 30 years amount to an exchange of goods for paper. America buys more goods than it sells, and sells assets, stocks, bonds, real estate, and so on to foreigners to make up the difference. America now owes a net $18 trillion to foreigners, roughly equal to the cumulative sum of these deficits over 30 years. The trouble is that the foreigners who own US assets receive cash flows in dollars, but need to spend money in their own currencies. In effect, the market worries that buying inflation protection from the US government is like passengers on the Titanic buying shipwreck insurance from the captain. The gold market is too big and diverse to manipulate. The dollar reserve system will go out not with a bang, but a whimper. The central banks will step in to prevent any dramatic failures, but bank balance sheets will shrink. Credit to the real economy will diminish, and international lending in particular will evaporate. The dollar frog will boil by slow increments. As dollar credit diminishes, these alternative arrangements will turn into permanent features of the monetary landscape, and other currencies will continue to gain ground against the dollar. Lower dollar, higher gold. Even in an emerging multipolar world, there's no obvious replacement for the deep, liquid U.S. capital markets, so the dollar won't disappear from global trade. However, if the BRICS have the commodities and the U.S. and its allies are left with finance, pricing power for crucial things like oil and gold will shift to Russia, China, and the Middle East. Falling demand for dollar-denominated bonds as reserve assets will send trillions of dollars now outside the U.S. back home, raising domestic prices, which is to say lowering the dollar's purchasing power and exchange rate. The loss of its weaponized reserve currency will lessen the U.S.'s ability to impose its will on the rest of the world. Witness China as Middle East peacemaker and India buying Russian oil with rupees. To sum up, tomorrow's world is multipolar, and for the U.S. and its allies, inflationary. That means a commodities bull market, at least in dollar terms, and extreme financial instability as the U.S. empire is forced to live within its means. It won't be pretty, but for gold bugs and commodity bulls, it might be extremely profitable. It has been quite the ride for the market since the big short investor sold with an initial spike after he tweeted, a significant sell-off that climaxed in the collapse of several banks, and a reestablishment of Fed balance sheet expansion. And that is perhaps why Michael Burry tweeted today, "I was wrong to say sell." This admission of an error is something seldom seen on Wall Street. So Burry deserves respect for owning the trade. And realistically, he did not lose you money on his record. So let's summarize. If it wasn't for this big federal funded squeeze, he would have, of course, been very right. Who could have seen this ramp coming? Not even the big short investor, Michael Burry. Short sellers are odd people. Most of them are ambitious, driven, antisocial, and single-minded. As individuals, they are not very likely to own a Rolex watch or a presidential Springer Spaniel or any other symbolic trappings of success. They are likely to have a very slightly twisted sense of humor. As a group, short sellers like to disagree, and they like to win against big odds. And they are frequently invariant in their regard for business leaders and icons of Wall Street. Maybe stacking physical gold is a good option after all. Own gold mining shares at the deflation crash is a good backup plan to hedge for declining dollar. You are such a good boy for watching my video right till the end. Bye.